Hey everyone, Jeff Dorman, CIO of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets. And as always, this is not investment advice, although we will talk about things happening in the markets. And I am joined today by Morgan Krupetsky, who is the head of institutions and capital markets at Ava Labs. So thank you for joining me.
Thanks for having me.
You're welcome. For those new to the show, this is what we do. We talk about the markets. We invite guests to hear their thoughts. Obviously, usually tied to what we write about on our blog. That's our two Satoshis. If you're more of a reader, you can find it this week at our website, ar.ca/blog. We're going to actually deviate a little bit. I actually wrote this week a little bit about kind of just the overall growth in crypto post the election, a little bit about the Hyperliquid token launch, as well as what's happening in AI and crypto. And we'll come back to that at some point. But I want to spend most of the time this week talking to you, Morgan, about what is going on at Ava Labs, and more importantly, with some of your predictions. I read a couple of the things you sent my way about your thoughts on stablecoins and ultimately kind of RWAs penetrating the real world. Why don't you start, just introduce yourself, give people a little bit of a thoughts of where you come from and where you're focused.
Sure. Thanks again, Jeff, for having me. I feel like we need multiple sessions to kind of cover everything that you just went through.
Well, you got 15 minutes. Our audience has a short attention span.
Exactly. So for those who don't know, my name is Morgan Krupetsky. I head institutions and capital markets at Ava Labs. Ava Labs is the licensed service provider to the Avalanche Foundation, from which the Avalanche blockchain network was formed. In my role, I really kind of partner with the whole spectrum of companies, from startups all the way through to large regulated buy and sell side institutions, so banks, asset managers, FMIs, as they issue and tokenize assets on the Avalanche network, and or as they build different products and services on Avalanche, really focused on kind of wholesale banking and capital markets use cases. You mentioned RWAs, Jeff, kind of in your introductory remarks, and I think from our standpoint, we've been focused on asset tokenization, RWAs, and last cycle is called STOs, really since the beginning. Even before it kind of regained in popularity 2 years ago. And as we kind of gear up potentially for the next bull market, we will still be focused on asset tokenization. So I think to your point, you mentioned the regulatory environment. It feels like it's definitely shifting. And we're all very excited. And I think, as we kind of go into this next cycle, we might be in a position where we actually start seeing tokenization being pro-cyclical now with kind of the pending bull market, hopefully.
Now let's talk about it. So you spent what 10 years plus at Citi, so you're a boring TradFi person just like myself.
Yep.
We're not all that bad for those who are more crypto native. But I've been my thesis forever on digital assets and crypto was that tokens are the greatest capital formation tool in history, and it ultimately democratizes access, meaning your early users, your early adopters become sort of the ultimate owners in a quasi-equity form of a business that you help to jumpstart, right? Imagine Amazon Prime, members, the early people actually getting Amazon stock, or the early, Uber riders and drivers got the majority of the stock, et cetera. Hyperliquid, great example of that. I talked about, for those who want to read the details in our blog, we talked about the fact that they just launched a token where 31% of the airdrop went to just the early users of the decentralized exchange. It's a great, it's a $9 billion token already on day 2 of trading. I mean, that's a $3 billion airdrop just to people who helped jumpstart this. With RWAs, it's always a little bit different, because what we're basically saying is, instead of having everything be this crypto native startup, we want to bring all these existing assets over to blockchain rails, which is kind of what makes more sense anyway, right? I mean, if you think of blockchain as a technology and not really an asset class, ultimately it's a wrapper, no different than the ETF is a wrapper. And you want to wrap as many things inside of it as you can, because it's just a better technology. But the problem with RWAs, or real world asset, coming over to blockchain, has been the infrastructure has been so segregated. Meaning, like, I run a crypto fund, for example. A crypto fund would make no sense if it wasn't for the fact that the operations and the workflows are just so different in crypto than they are everywhere else, that it kind of has to be a separate entity. Whereas, like, nobody would launch an ETF fund, because people would be like, well, what the hell are you talking about? Like, what ETFs are you buying? Like, I don't need you for this. So how do we bridge that gap to even get to the point where you have these real world assets trading on blockchain or existing on blockchain? We have to bridge the infrastructure gap, and we have to bridge the workflow gap, in the sense that, like, I don't want to have to sell my Tesla stock, wait T+1 for it to clear in my brokerage account, transfer money from my brokerage account to my bank, transfer my bank dollars into Coinbase, and ultimately have Coinbase then buy assets that I can distribute on chain. Like, that's a workflow that doesn't make any sense. So if we're going to envision a world one day where every company, every entity, every municipality, every university is issuing tokens, and every asset is ultimately available on chain in some sort of tokenized form, we got to solve that infrastructure part, right?
Yes, so lots to cover there. So agree that the infrastructure definitely has to continue to improve. I think it definitely has over the past few years, and definitely since the last kind of cycle. But to your point, the more and more kind of integration that we have with blockchain-enabled technology with the traditional systems, and as we upgrade the traditional systems, at some point there will have to be interoperability between the two of them, so as not to kind of create more frictions, especially when you're talking about the tokenization of public assets. At some point, we will have to start seeing kind of upgraded infrastructure. And it's tough, right? Like you're upgrading infrastructure from like the 1970s. So it's not going to take overnight. But I have a strong view that we will get there. Maybe it's worth kind of taking a step back to understand, at least in my opinion, why potentially this time is different from an RWA or tokenization standpoint compared to last time. I think one of those key macro factors is that we do have more institutional grade infrastructure in place this time versus last time. So whether that's tokenization platforms, I mean, Arca also, right, has a licensed broker dealer, RIA transfer agent. So all these tokenization platforms that are able to kind of facilitate the compliant security token issuance and in some cases trading of these assets, plus custody, plus on and off ramps, plus KYC, AML, transaction monitoring capabilities, new ERC standards that really enable tokens to kind of align with the compliance and restrictions of particular kind of underlying assets to the extent that they are securities. So there's definitely a lot more room to go, but I think it's worth kind of realizing, and especially with the advent of stablecoins, right, that there's definitely much more kind of institutional grade infrastructure in place today versus back then.
Well, let's talk about that, because you mentioned that one of the predictions that you sent me ahead of time was that stablecoins and tokenized money market funds will go more mainstream as Web 2 companies start to use them as an upgraded tech stack to offer new and improved products, services, and capabilities to their clients. So effectively what you're saying is non-crypto native companies are going to start using stablecoins. How? Because and by the way, the stablecoin is obviously one of the best use cases of crypto to date, almost $200 billion of assets in terms of stablecoins and money market funds. But like when I look at the growth of the BlackRock tokenized money market fund or the Franklin Templeton tokenized money market fund, my question is more just like, most of that is still going to crypto native people, right? It's not being used yet by a corporate treasurer. Let's say, Apple has, $100 billion of cash on their balance sheet. Why shouldn't some of that be in stable coins or in money market tokenized funds? And the answer is, I don't know what they're going to do with it yet, right? What are they going to do with it other than eventually bring it on chain and try to earn some yield, or make an acquisition at midnight on Saturday when no banks are open? So what is the vision there? Like, how do we get to that?
That's a good question. I think when you talk about developed market investors, whether they're individuals, institutions, or corporates, to your point, there needs to be a very kind of compelling value proposition or utility that a tokenized asset is bringing to that end user, right? Whether that's zero fees or tremendously less investment minimums, or something that, and we always ask our partners, well, why would someone who has ready access to this thing off chain, why would they access it on chain, right? No one's clamoring for tokenized assets, but to the extent that tokenized assets allow them to have access to certain products and capabilities that they don't have otherwise, that becomes really interesting. So obviously the bar for that is much higher for someone like an Apple than someone in an emerging market who doesn't have ready access to US equities, as an example. So the quote unquote value prop is definitely different depending on which end user or customer you're talking about, if they're US based, not US based, if they're retail, not retail, so on and so forth. I think when we're talking about kind of the proliferation of stablecoins and money market funds, really beyond crypto natives, I would point to kind of the neobanks, startups, fintech originators, embedded finance platforms, frankly, in the US and globally, who are just less burdened by tech debt compared to some of the incumbent institutions. And they have the luxury of being able to leverage a combination of blockchain tokenization, smart contracts, and again, whether that's stable coins or money market funds, just depends on kind of what the use case is. But they have the luxury of being able to kind of architect and use a lot of that tech stack from scratch rather than, force feeding it into an incumbent institution. I think to date, most of the innovation that we've seen in the fintech space has really been innovation to the front end. So to the UI, to the UX, and really kind of enabling a lot of ultimate benefits to the end user. But in the back end, it's all still spaghetti soup. And so to the extent that any one of these players can kind of start leveraging this upgraded back end, I think it will put them all in a kind of a competitive position, either with respect to each other and or with respect to the incumbents who just aren't as nimble. One example that we've worked with is a company called Open Trade, who provides effectively dollar-based exposure and dollar-based savings accounts, i.e. via yield on USDC and via a B2B2C model. So one example that's publicly known out there is their work with a Colombian startup called Lidio, who provides Colombian locals access to dollar accounts and dollar-based savings accounts. A lot of the times, those customers may or may not know that they're using kind of crypto or tokenized assets in the back end, but now they have access that's pretty easy through the app to dollar-based accounts and dollar-based savings accounts. Another example I would give is a company called Denari that we're working with that operates in very much a similar way, but they're providing access to U.S. publicly traded equities to, again, mostly retail end users outside of the U.S. who don't have ready access. So I think in the first instance, from a non-crypto standpoint, it's offering these products to largely non-US users who don't have ready access to some of these things. But I think over time, you'll start to see more and more US companies start to kind of adopt this technology in the back end and then create a competitive advantage for themselves compared to those who are still using like a traditional Web 2 tech stack.
Right, that makes sense. The other thing you said was, we'll start to see other types of financial assets besides just, cash and treasuries. Basically, other types of real world assets being integrated with the traditional distribution channels for individual end investors. And I think what you mean by that is basically all kinds of assets are going to be tokenized, right? And I don't know if this is a prediction for 2025 or a prediction for 2035. But one of the things I always thought about when it came to more assets being tokenized is one of two things has to happen. Either you have to tokenize something that is so valuable that people have no choice but to find a way to get a wallet and buy it, meaning, you tokenize the Statue of Liberty or the Titanic, or, Apple says, or NVIDIA says, we're literally pulling all of our assets off of, the NASDAQ or the NYSE. And the only way to get NVIDIA upside stock anymore is to, own it through some tokenized form. You need something so valuable that it forces people to use it. Mm-hmm. Or conversely, you just need to hit that tipping point where everybody has a wallet and every company has a wallet. And by then it's just no different than any other workflow. And it just starts to kind of slowly come on over, right? Again, what are the types of assets that you see being tokenized, and how do you see kind of getting to that tipping point that I'm talking about?
Yeah. So from our standpoint, just because we kind of sit at a layer one ecosystem level, we see it all. And so literally you name it, and I've heard that someone's tokenizing it. In terms of how I would kind of categorize or bucket these things, on the one end, so we already discussed like tokenized cash and cash equivalents, stable coins, yield coins, money market funds, which frankly lends itself also to FX and other types of really interesting kind of payment use cases, as well as US public equities, which I referenced earlier. But then on the other side of the spectrum, we're seeing a ton of interest in the tokenization of kind of private market assets, in various forms, but also largely through like fund forms. So, the thesis there is that, the same really high quality alternative asset managers have really overly saturated the institutional investor market from an allocation standpoint. And at the same time, you've had this growing kind of mass affluent and accredited investor market in the US and globally who doesn't have systematic access to alts, and particularly at lower and more palatable investment minimums. So the idea would be there to, right, tokenize not just the end interest, but as much as possible, kind of the end-to-end asset management lifecycle in order to enable kind of GPs to take on a greater number of LPs through lower investment minimums. There, I really do believe that we need to start integrating these assets into traditional distribution channels and really meeting investors where they're at, i.e. via RIAs, other types of like traditional wealth channels,
Right.
The ability to kind of offer these things through Fidelity or Schwab apps, really meeting investors where they're at. I mean, frankly, one seemingly unrelated but very related example is there's this game that launched on Avalanche called Off the Grid. I'm not a gamer, but it's really cool. And ultimately, the game has garnered millions and millions of users and millions of transactions. And the key there, in my mind, was that they ultimately met gamers where they were at, right? Through Xbox, PlayStation, and their PC, which is where the gamers already kind of play their games, through the Epic Game Store where they access games, and then through Twitch where they watch games. So to the extent possible, abstracting away all of the blockchain complexities and the kind of UX friction, that will be key, I think, to really meeting that end audience and liquidity in the case of tokenized assets where it's at, which is so far not really on chain today. So I really do believe that, and then the Denari example was a good example, right? They're embedding their offering through various types of Web2 platforms where those in turn already have active KYC'd users and a client base who, again, may or may not know that they're being able to access Google stock now because it's happens to be tokenized, but not because it's tokenized.
Right. Okay. So I agree with that. And I think, look, a vision of mine one day, nobody will ever own cash ever again, because ultimately, if you really believe in a world where all assets are tokenized, and one of the benefits of blockchain tokenized, one of the benefits of any blockchain asset is that you can essentially move it freely, right? If the internet is, the way communication is sent globally, seamlessly, free, instantaneously, and blockchain is the same thing, but for asset transfer, you can say anything that can be an asset can effectively be transferred for free, globally, instantaneously. Ultimately, if you make the world more accessible as on-chain assets, you'll never have to have cash again. You'll just always spend your assets. Now,
Yeah.
you have to assume that there's an actual live market for this stuff, right? Just because you tokenize the LP interest in a fund doesn't mean that all of a sudden there's going to be a market for it in an observable price. But if you do believe that markets will eventually exist for just about any asset, then that just eliminates all cash altogether. You just are 100% invested at all times, and your investments become your payment vehicles.
Yeah. And that's obviously that's the dream, right? For you to be able to like tap your phone and draw down from your equity portfolio to be able to buy a cup of coffee. And then that opens up a lot of questions around like tax implications and what does that look like? But I think we'll get there. I mean, I think, there on the one hand, it's really interesting. It's like the tech and the innovation has almost moved faster than like the regulatory environment. And then versus some businesses, just in terms of like a lot of this tech is already in place to be able to kind of operationalize and effectuate a lot of that stuff. And I think it'll come. It's just, I think the first kind of step, right, is tokenizing those assets, integrating them with traditional distribution channels, cultivating initial demand, right, which then sets you up to potentially have a more robust secondary market, and then additional utility such as collateral mobility, so on and so forth. I think a lot of people kind of just like rush to the end of what this could mean. But it's definitely like a phased approach. And I would say, like, at the end of the day, a crappy asset is a crappy asset, to use the technical term. And just because you tokenize it, like, it's not like people are going to like run to buy it. I've always looked at the tech, whether it's blockchain or tokenization or smart contracts, it's really an enabler, right? It allows you to transfer value much more quickly. But if that value is not valuable, it doesn't make it valuable, right? It doesn't like magically generate demand in a secondary market. So it's definitely, I think, like a phased approach. But, you know, to your point, I think at some point all assets will be tokenized and it'll be much easier to transfer, to use, and kind of financialize a lot of things that are frankly immobile or illiquid at this point.
Yeah, and I think this is the big crypto investing paradox right now, is that we have all this infrastructure and tech that now works really well and is really useful, but the assets available on the tech largely suck. Meaning, like, go back to the month and a half ago when you had the yen carry trade collapse, and basically every brokerage was down for like hours. It would have been great if that was DeFi's onboarding moment, and you could be like, you know what, I'm not going to trade on Schwab or E-Trade or Merrill today because it's down. I'm going to go take my assets and send it over to Uniswap or send it over to Aave and use that as collateral or to trade on DeFi. That would have been great. DeFi worked seamlessly during this period, and brokerages and banks did not. The problem is, as everyone knows, DeFi, the rails work fantastically, but the only assets you can actually trade on DeFi rails are a bunch of crappy crypto assets that 99% of the world doesn't care about. So we know it works, and this is where I come back to the workflow part. Is like, we know it works, right? This is the equivalent of, say, you see airplanes and you're like, wow, airplanes are really great, but for whatever reason, the only thing you could transport on an airplane was like rocking chairs or something that nobody cares about. It'd be like, as an investor, I'm going to invest in airplanes. I get it. I see the future of where airplanes are going to transport more than just rocking chairs. But the general public will say, well, that's great for the future, but right now all I can transport is rocking chairs, so I don't care about airplanes. And like, that's where we are right now, is that the technology's there. It works. We know that more stuff is supposed to be on chain, but it's not. And as a result, unless you're a 10-year forward investor, most people just don't care. Like, I'd imagine half your friends from Citi think you're nuts for what you're doing right now and don't even understand it. Or maybe they do understand it and they're even invested in it, but they just don't care because there's nothing on crypto rails that they care about.
Yeah, I mean, I think it's funny when we meet with different projects and a lot of their kind of go-to-market focuses on crypto natives. And I'm like, guys, there's, in the grand scheme of things, like 5 crypto natives or 5 people on chain, of which like we're 2 of them. So yes, when you compare kind of the universe of active on-chain investors today with what it could be, it's obviously extremely small still. But I do think, again, kind of going back to why this time is different, I would say, when you do compare the types of assets that are on chain today in terms of RWAs, objectively, they are better than the last time around, right? You have the likes of BlackRock and KKR and WisdomTree and Franklin Templeton, who are obviously very well-known asset issuers, tokenizing assets on blockchains. So I think it's definitely improved and is continuing to improve. And I think, for whatever it's worth, every bank and asset manager that I talk to is in some way, shape, or form focused on tokenization. So I think the asset mix and the asset supply is improving and continues to improve. I think there, to your point, needs to be a merging of those things, merging of the asset supply with the DeFi capabilities. And I think a lot of different protocols are working to figure out how to operationalize that, right? But because a lot of these things are securities, there's obviously laws, rules, and regulations that govern them that don't at this point govern certain tokens, that therefore you just have certain capabilities that have just surpassed like what you can do with RWAs to date. But that said, I mean, that is not lost, and there are active efforts to kind of merge those 2 worlds. And in terms of like what I think maybe the future will look like, again, like I think this will continue to merge. Maybe you still will have a cohort of individuals globally who are accessing Aave and Uniswap directly, but then there might be others who are accessing it through their Fidelity app or whatever it is. So I think like there could be a world where we parallel path some of this stuff, but anecdotally, this is very top of mind and high priority, I think, for a lot of people who are focused on tokenization.
Okay. All right, well, take us home. We only got a couple minutes here, Morgan. What's the number one prediction or number one takeaway for people thinking about growth of avalanche or blockchains in general and real world assets, where it's going to come from. Like what's the home run one-liner you want to leave people with?
Near term, and by near term, I mean 2025. I would say watch the more liquid space, the stablecoin space and money market fund space, especially on Avalanche.
Very good. Well, Morgan, where can people find out more about what you're working on, or you in particular? What's the best way to reach you?
Sure. Best way to reach me is either on LinkedIn, where you can just search my name, or Twitter, where my handle is Morgan Krupetsky. Happy to answer any questions or take the discussion forward.
Fantastic. Well, I really appreciate you joining. For this week, guys, that's everything. We'll be back again next week with more predictions from another guest. I'll be out with my predictions in the beginning of the year, first week of the year. As always, you can go on our website, ar.ca/blog. Check out any of the writings or research we've done at ARCA, including this week's write-up, which I know we didn't get to, but if you care about AI agents and bots, and you care about hyperliquid and you care about just markets in general, definitely go check out the blog this week. But we'll be back again next week. And Morgan, I really appreciate you joining, and I learned a lot. Thank you so much.
Thanks, Jeff.